Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Here's what we're watching this hour. First up, we'll bring you the details of the U.S.-China trade truce and what that means for the markets and the economy. Plus, we'll dig into big tech's massive AI spending and whether it's actually paying off. And we push ahead to Apple and Amazon results after the closing bell. Let's take a look at the major averages here today. Obviously, a lot to consider for the markets. We have that U.S.-China trade truce going on. We have big tech earnings. And, of course, we had the Federal Reserve yesterday cutting rates by a quarter percentage point and also indicating that a December cut's not a foregone conclusion. What does all of that equal? Well, it equals actually an increase for the Dow at the moment, although indications were for a drop at the open. Well, we got the Dow gaining more than 200 points, up about 0.5%. The S&P 500 down about 0.5%. The NASDAQ, not surprisingly, falling the most here today, 0.5%. We'll dig into stocks in a moment, but I just wanted to look across asset classes first before we get there. Interesting to see yields moving higher here. The 10-year yield at 4.11%. We saw that step change up yesterday, of course, after we had the Fed press conference where Jay Powell sort of said to the markets, not so fast, guys. We don't have the data right now to really cut rates with certainty necessarily at the December meeting. So here's the year-to-date movement. Of course, we've seen it mostly move lower yields on the 10-year, but then that little uptick in the wake of the presser. Bitcoin, interestingly, is moving a little bit lower here this morning, off by about 4.5%, and gold futures are rebounding a bit, although not really much changed at the moment. So let's dig into what's going on in stocks, because the story today really within the equity market is indeed what's going on with large cap technology and the sort of split in spending perceptions on the part of big tech. Meta shares are off by 11% today after that company said it's going to spend even more next year, more than the $72 billion it's planning this year on its capex. The market not liking that, not at least perceiving that it's necessarily bearing fruit as of yet. Microsoft also ramping up its spending plans, saying it doesn't have the capacity to meet the demand that's out there, even though underlying numbers looked good by many metrics. The shares off by 2.2%. The exception, of course, this morning is Alphabet. Those shares up by 5%. It's ramping up spending too, but guess what? Search revenue was up by 15%, and it is increasing the number of folks who are using its Gemini AI platform. So those shares are benefiting. So big cap tech, a big part of the story this morning, and we're going to dig more into that in just a few minutes. But first, getting back to the U.S.-China story, President Trump appeared happy with the progress made on U.S.-China trade negotiations Thursday, which tackled fentanyl tariffs, rare earths exports, and soybean purchases. Here's the president speaking on Air Force One following the meeting.
I thought it was an amazing meeting. I think pretty soon we have not too many major stumbling blocks. We have a deal. Now every year we'll renegotiate the deal, but I think the deal will go on for a long time, long beyond the year.
For more on the deal and where trade talks go next, we've got Iam Bremmer, Eurasia Group founder and president. Ian, it's great to see you. I know you were just in Asia. I don't know if you're still there, but you were, and monitoring all of these developments. So how significant is this a breakthrough? Like, how would you characterize this meeting between Xi and Trump?
I'd call it a truce. I would not call it a breakthrough. I think it creates more stability in a relationship that has had more stability until Liberation Day. It was then unilaterally destabilized by the United States, and the Chinese uniquely hit the Americans back as hard as they were hit, and were very credible. And that happened not only on tariffs, it also happened around export controls and licensing agreements, and the Chinese have a lot of leverage, and they have a willingness to use it. And so I think that President Trump went to meet with Xi. It was relatively well prepared by Scott Bessent on the U.S. side, by Premier Li and Li Chenggang on the Chinese side. It was a short meeting. It was only 90 minutes long. It was expected to be 3 to 4 hours. With translation, that means that it was really only a 45-minute meeting. So most of what was expected had already been discussed and agreed to. There was nothing on Taiwan, though the Chinese had floated it. There was nothing on Russia, though Trump had floated it. It was really just, hey, let's make sure that we don't have a boycott. We're not in a trade war. And so in that regard, it was kind of table stakes, close to the minimum you could expect to stabilize the relationship, but long term still looking at a trajectory of decoupling and still looking at a global environment where the United States and China are adversaries and are working to take advantage of their position vis the other. And that I think that's really important, right? When the Americans are trying to take Chinese transshipments out of other countries, trying to coordinate rare earths and AI and chip and national security away from China, those are the trends that are still happening, even though I know Trump said that the meeting was a 12 out of 10. It's even better than Spinal Tap. It's even farther than 11. That's just not true. It just ain't so.
This one goes to 12. Maybe that's in the Spinal Tap sequel. I haven't seen that one yet.
The reboot.
Yeah. That said, we've been covering the corporate earnings here. And, yes, companies are talking about tariffs, but it is not seen as the disaster that it once was, at least when it comes to earnings and how U.S. companies are navigating them. Maybe soybeans would have been more of it, certainly wouldn't have been good for farmers. Maybe rare earths would have been more of a disaster. But I'm just curious how you view the U.S. negotiating position, given that the U.S. economy seems to be chugging along just fine.
Oh, the U.S. negotiating position is stronger everywhere else. It's not with China. The Chinese have an economy that is not as large, but they have a political system that can handle pain in a way that the United States is not as credible, certainly with inflation, and that we do have polls in the United States and we do have an election cycle. China, Xi Jinping doesn't have to worry about that. But when you talk about the Europeans or the Mexicans or the Canadians or Japanese or South Koreans, these are all countries that have economies that are substantially weaker than the U.S., that rely on the U.S. for security, rely on the U.S. for technology, rely on the U.S. for the dollar, for treasuries, for the banking system, and find the Americans both unpredictable and unreliable. So they're trying hard not to get involved in a fight with the U.S. And if that means a deal that asymmetrically benefits the United States, they'll accept it. The South Koreans are coming away with a win because they don't have to spend a full $350 billion, which they barely have. It's almost all their foreign reserves. By the end of the Trump term, instead it's going to be $200 billion with $20 billion a year. That's a win for them, and yet it's absolutely asymmetrically benefiting the United States. So the Americans are clearly in a stronger position compared to their allies.
And Ian, so, to sort of boil it down, has Trump's strategy largely worked then when it comes to strengthening the position of the United States in terms of investment and in terms of its trading allies around the globe?
Near term, I would say it has been successful on a relative basis. In other words, if what you care about is how the United States is faring compared to weaker allies, the United States is in a stronger position today than it was 6 months ago. If you're interested in absolute gains, the United States is weaker because, of course, it's undermining the long-term competitiveness of American corporations because they have to pay more for goods, undermining the long-term well-being of American workers because they've got to deal with higher inflation that will continue to go higher. They have to undermine the position, the U.S. fiscal position, because the U.S. has to spend more money in a higher interest rate environment to service the debt. And long term, so many of these other countries are going to look to become more resilient and rely less on the United States because they can't trust the Americans as much. I was just with a really good friend of mine, literally in the office a moment ago, former prime minister of a European country, who's talking about how the Europeans don't need the United States for Ukraine for the next 2 or 3 years, that the Europeans are spending all of the money on aid and reconstruction. That's good for the United States because they don't have to pay, but long term it weakens NATO and it weakens EU relations with the United States in alignment. The EU will do more with India. They'll do more with Asian allies. They'll even do more over the long term, probably with the Chinese. That long term doesn't benefit the U.S. But of course, as you and I have discussed before, the Americans are a short-term nation. We're not a long-term nation. The Chinese focus on the long term. So as long as we don't care about the long term, this is a fantastic presidency.
Ian, finally, you gave a speech recently in Tokyo where you talked about all these issues, and you also talked about the political environment in the United States. And something else we've also talked about is that political environment on the one hand versus the economy and the markets on the other, which, as we know, yes, today notwithstanding and a little bit of weakness, have been pushing to record high after record high. And I'm just curious how you think about the sort of unstable political environment versus what seems to be a very stable and rising market and economic environment.
So if the Dow is at record highs, we could certainly say if there were a political Dow for the United States and the legitimacy of U.S. institutions, it would be at a post-Civil War record low right now. There is so little trust in it. There is so much division. And the U.S. president believes that his own domestic political adversaries are the most important enemy of the United States in the world, more than Russia, more than North Korea, more than China, where he just did a deal. And a democracy cannot last for long when its people believe that their principal enemies are inside the house, when the call is coming from inside the house. And that, of course, means that not only is Trump focused heavily on sovereignty, which is what we've talked about so far, control of borders, control of the economy, more investment into the U.S., all things that, generally speaking, the companies and the markets are favorable towards, but also a political revolution to ensure that the political enemies of Trump and therefore the United States can never take over the country again. And that requires that the president ensures that there are no longer checks and balances on the executive, either from the legislature, from the judiciary, from the administrative state, and that the Democratic Party cannot win again. Now, he may not be successful in that political revolution, but that is the intention. And he's done an extraordinary amount to bring it about in only 9+ months. We've got 4 years minimum of a Trump administration. And clearly that's the biggest geopolitical story out there.
I would pull on that minimum thread, Ian, but we're out of time, unfortunately. So we'll have to leave that for the next one. Great to see you.
I don't think he's running for a third term, so okay. At least we can leave it with that.
Okay, good place to leave it. Thank you, Ian. Good to see you, and we'll talk again soon. Appreciate it.
Sure.
Much more markets action coming up. Stay tuned. You're watching Market Catalysts. A tale of two tech earnings stories. Meta and Alphabet getting vastly different reactions from Wall Street to their reports. Meta right now down 11.5%, Google up 5%. Investors seem wary of Meta's increased spending, but Alphabet's being rewarded as its cloud growth shows strength. Joining me now on this, Brad Erickson, RBC Capital Markets equity analyst. It's good to see you, Brad. Thanks for being with us.
Of course. Nice to see you too, Julie.
In recent quarters, investors have looked at Meta's results and they've said, well, the AI is working. Ad sales are up, and they're using AI in their business. Why was that not the reaction this time?
Yeah, and maybe just to lay out like the simple formula of why these will work or not work, there's kind of like three things they have to do. Number one, they have to show how the core business is working and funding these investments. And if you have AI as a part of that, which both Google and Meta do, that's great, right? But you need to keep beating expectations. The second one is you have to give investors a view and a vision for what these products and what these investments, frankly, can produce in the future that's not present today in the business. Google has given, I would say, a crisper or more substantive view, more likely view of success in that. And then the third one is obviously the spending levels and taking those up. And so with Meta last night, the key issue was the Q4 guidance came in a little bit soft, and it wasn't a lot. And honestly, they'll end up probably beating, we think, Q4. But the numbers are the numbers. And when you're raising spend that much and you're not giving people a vision that they really believe in on Meta AI or Vibes or any of these new things, just makes it hard. That's why the stock's getting kind of killed this morning.
So let's take that vision part of it and dig into that a little bit, Brad. What is it about Meta that is not convincing investors in terms of that, like, this is what we're doing with this in the future?
Yeah, totally. And they talked about, when or if they see a paradigm shift. The way we frame it is that, Google adding AI overviews and AI mode and Gemini is really kind of a natural extension of search, right? Like we're all learning how to use this stuff. It's prompting new questions and new things we're asking for it. With Meta AI, I think you can make the argument that is a kind of totally new realm of utility, right? That people haven't looked to Facebook or Instagram to before. And so there's a bridge to cross there for Meta. And that's not to say the product's not going to be good, right? They have the super intelligence labs working on sort of making the model, they use the word novel, right? Which means differentiated from ChatGPT or what AI overviews or AI mode might look like on Google. But they're not there. And I think investors are sort of struggling to understand how they will get there because we just haven't seen the product. It's not in existence technically at this point. So that's kind of the issue.
And to your point, with Google, it's there. You Google stuff and it comes up, and it seems to be working. And they also saw, the Gemini app with 650 million monthly users. Was that also a surprise? And how important is that for Google to keep on growing that?
Yeah, the Gemini app certainly matters a lot, and that's kind of the direct comp to ChatGPT. So all good on that front. I think the incremental data point last night was the 75 million daily active users on AI mode, which they really only rolled out maybe like 5 or 6 months ago broadly to the US and Europe. That is super important because I think, for some of the early adopters and the hyper users of these, they will use, the ChatGPT app or the Gemini app, for example. But for kind of the broader masses, I would say AI mode is probably going to be one of the first introductions people have to generative AI. And the fact that that's starting to grow very, very quickly is a really good signal, I think, for Google.
What does that tell you about these concerns that people are going to just be going to ChatGPT, for example, and not Googling anymore? Is it still going to happen? Maybe it just pushes it further off?
I would say right now there's the fact pattern and the data points that have come out lately just do not support that view. That's not a knock on ChatGPT. Their growth continues. The adoption of that is still going really well. I think from a Google perspective, though, there's just clear evidence of incremental searches that people never would have done in a sort of traditional search environment. And if you continue to do those, there's going to be a portion of that mix that is very commercial. And Google is set up with 15 million plus advertisers to monetize that immediately. And that's what they said last night. It's already contributing to the growth of the search business. So there it is.
Brad, I want to ask you a bigger picture question on spending. Obviously, all of these guys are still increasing spend. They still expect to increase spend next year. Like, how far are we from a peak in capex on this, or you can't even see it?
Yeah, I don't even think that's the $1 trillion question at this point. That's like the $10 trillion question. Nobody knows, right? Like, I think, and last night sort of added to that uncertainty using Meta as the example, because like I said earlier, the revenue guide was not as good probably as people were hoping for Q4, which is necessary, again, for investors to continue underwriting these investments. And yet, Mark took up the capex guide arguably in the order of $15 or $20 billion. So, well in excess of $100 billion a year now. So they're not even showing, in that case, they're not even showing sort of a sensitivity to revenue being tied to capex, which means that it could go up, indefinitely. So yeah, we don't have an answer there.
Fair enough. And then finally, I did want to ask you a quick one about Amazon, which we're expecting after the close. And I believe you have an outperform rating on that one. The sentiment around Amazon has not been fantastic lately. What do you think they need to do tonight to sort of maybe get a little mojo back?
Yeah, it's like everything kind of with the mega caps that we cover this earnings season. There's numbers and there's narrative, and both of those things need to happen in a solid way tonight. Numbers wise, AWS probably needs to grow at least, I would say, 19%, and then second or higher. And then secondarily, the conference call will be especially important in that management had a tough call last quarter. They did not address the competitive question very well in terms of why they are growing so much slower than Microsoft and now it looks like Google as well. They will have to put on a better performance around that. And again, give people a vision of why that can't accelerate next year. Google winning Anthropic with this new contract they signed recently, that was a tough data point because that, in theory, a lot of that business might have gone to Amazon, and now we're sort of not so sure about that. So addressing that on the conference call is really going to be important on top of the numbers.
We will be watching both of those elements. Brad, thank you so much. Appreciate it.
Thanks for having me.
Let's send it over now to our Brooke DePalma live at the NASDAQ. Hey, Brooke.
I'm Brooke DePalma, and yes, we are live at the NASDAQ here in Times Square. Let's turn now, though, to today's top analyst calls on Wall Street. We're watching shares of Meta, Chipotle, and Steve Madden this morning. First up, we have Meta. That stock is plunging today as investors are worried around its AI investments. That led Oppenheimer analyst Jason Helfstein to downgrade the stock to perform from outperform. He said the company's significant investment in superintelligence, despite unknown revenue opportunities, well, it kind of reminds him of 2021 and 2022 metaverse spending. Benchmark also cut its rating on the stock. Next up, we have shares of Chipotle. That stock also sinking this morning after it reported earnings. TD Cowen analyst Andrew Charles cut his price target on stock to $40 from $45. And in a note to clients, Charles said shares, well, they're in a penalty box for the next 3 to 6 months, given a September and October slowdown, and that's due to less spending by Gen Z. With today's sell-off, the stock is down more than 40% year to date. And last up, Steve Madden, ticker symbol SHOO. Telsey Advisory Group upgraded the stock to outperform and raised its price target to $43. Now, the firm believes the company has been delivering trend-right products to market quickly. It's also grown its apparel and accessories business, and it's expanding internationally. Right now, the stock is about $35. Keep it right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching Estee Lauder, MasterCard, and Bristol Myers. First up, Estee Lauder reporting profit that beat expectations. The company also reaffirmed its fiscal 2026 outlook. Those results show its turnaround efforts are paying off. Part of that includes sharpening focus on Estee Lauder's most successful products. It's also hired external advisors to review its portfolio of skincare, hair care, and cosmetics brands. And Estee Lauder is lowering some prices to attract shoppers at a time when competitors are hiking prices. Next up, MasterCard reporting third quarter earnings that beat analyst estimates. The earnings performance driven by healthy consumer and business spending. That's according to the company's CEO. The payment giant also reaffirmed its net revenue outlook for this year. MasterCard's rival Visa also reported a strong quarter earlier this week, highlighting spending resilience. And finally, Bristol Myers raising its revenue outlook for the year after newer medicines outperformed expectations. Those results easing pressure on its portfolio of aging blockbusters. Bristol relying on its newer portfolio to offset the loss of exclusivity for older medicines. It's also betting on an $11.1 billion partnership with BioNTech to reignite growth. The company's poured billions into acquisitions as patents for its legacy drugs near expiration. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, ServiceNow reporting strong growth. We'll talk to the CFO next to discuss the company's path forward as AI demand surges. That's next on Market Catalysts. ServiceNow topping third quarter estimates with revenue up 22% year over year. The software company also raising its full year subscription revenue guidance on strong AI demand. Joining me now, Gina Mastantuono, ServiceNow president and CFO. Gina, it's great to see you. So stock trading a little bit higher here this morning on these numbers, the subscription revenue that you guys are talking about for this quarter of about $3.43 billion. So just talk to me about the demand drivers here and where you are seeing the demand going right now.
Well, thanks so much, Julie, for having me. Great to be here. So proud of the team for another spectacular quarter. Just incredible momentum, elite level execution, and most importantly, incredible customer impact. So yes, we were able to exceed both top line and bottom line metrics pretty handily, which allowed us to raise not only revenue for the full year, but also our operating margin by 50 basis points and free cash flow by 200 basis points. And the demand drivers are clear. So our AI business is just doing phenomenally well. We're seeing real measurable results because our AI is built in and not bolted on. We're on pace to exceed $500 million this year in AI revenue, which is tracking well above our targets for $1 billion goal through 2026. We had 12 deals greater than $1 million in the quarter, including one over $10 million. We had AI control tower deal volume, which was 4x quarter over quarter. And this is because our AI business, we're able to connect any data model, any data source, and any cloud across the enterprise with trust, governance, security, and results at scale. Not only are we doing this for our customers, but we're also driving over $350 million of annualized value internally from AI productivity gains. We've invested a good chunk of that back into the business, into our growth initiatives, but we've also been able to drive more than 100 million to the bottom line just this year alone. So we're seeing real durable demand. It's not just hype here at ServiceNow.
Okay, so Gina, get a little more granular for me there, because how exactly, the products that you guys are using that have sort of the AI bolt-ons, how much more are you charging for this stuff? And what exactly is it doing for the enterprises that are using it?
Fantastic question. So as I said, it's actually not AI that's bolted on, it's built into the platform. And so we're using it across the enterprise. Ulta Beauty, a great customer of ours, is automating tons of manual tasks. Think about store management requests and store maintenance requests across 1,400 stores. AstraZeneca is deploying the AI control tower to manage and govern all of their AI initiatives at scale. And so we're really seeing such great progress. From a cost perspective, we continue to see about a 30% uplift for all of our AI products. So our customers are seeing the value, they're willing to pay for it because we're driving exceptional value for them across the board.
I'm so curious as well how you guys are using this internally and what it means also for, your sort of headcount. We definitely have seen some decreases related to AI in various parts of the tech industry. So talk to me how you guys are thinking about that.
So it's fantastic. So we're not reducing headcount, but we've absolutely been able to reduce our increases in headcount. So from the beginning of the year, when we came into 2025, the expected growth in headcount is significantly lower than originally planned. That's the 100 million of cost savings we were able to drop to the bottom line because we absolutely believe that there's a human element to AI. It's going to augment people, not replace them here at ServiceNow.
One of the other things that I know was a concern on the part of some analysts and investors going into the quarter was federal government spending. Obviously, the government is shut down. I know you guys talked a little bit about that on the call and, kind of what that could mean. Can you tell our viewers a little bit about that? How much of your sales are government contracts and what kind of visibility or not you have right now?
Well, our federal business is one of the strongest in the company. The team is just executing amidst pretty uncertain environment. And we had the strongest Q3 ever. So Q3 is always the largest quarter for our federal business. And we had the strongest Q3 ever. Our Fed business grew over 30% year over year. And that's driven by the modernization demand. We're really helping governments run like the best run businesses in the world. And so we're really excited. Demand is strong. The results in Q3 prove it. Certainly, the government shutdown right now might impact some deal timing in Q4. So we called that out specifically, but it's a timing issue only. Demand is really strong because we're really helping the government boost efficiencies by 30% across operations. And so again, durable demand, real confidence in that business and the opportunity going forward.
Gina, you guys approved a 5-for-1 stock split. Talk to me about the thinking behind that and whether this is, sort of aimed at retail investors and making ServiceNow's stock more maybe appealing to them.
Well, it's a great question. We're really excited about this. Our stock price has appreciated very significantly over the last several years. So this 5-for-1 split not only demonstrates the continued confidence in ServiceNow's growth trajectory, but absolutely it's greater perceived affordability and accessibility, not only for retail investors, but across the board.
And Gina, you mentioned the 5-year return of the stock. Year to date, ServiceNow, like other sort of large enterprise software companies, the stock has struggled a little bit on this perception that AI is going to come in and maybe replace some of the functionality that you guys bring to the enterprise. I'm sure you've heard these concerns. How have you been sort of addressing them with investors?
Well, listen, enterprise is so different than consumer. The need for secure, governed AI is so important. Workflows and business processes in the enterprise are so very complex. And so we keep continuing to outpace expectations, to beat expectations, because we're not going anywhere. Our products are exactly what our enterprise customers need. It's driving significant value. And we absolutely believe that AI is going to be a revolution in the enterprise. And we are so well positioned to capture that opportunity and to help our customers transform during what we think is going to be a generational shift in how work gets done in the enterprise.
Gina, great to see you. Thanks for the time this morning. Appreciate it.
Thanks so much, Julie.
We're counting down to a big day here at Yahoo Finance Invest. It's on November 13th, starting at 8 a.m. Eastern, and we've got a full day of live coverage of the key themes that are driving this market: AI, crypto, and much more, with the top guests you'll want to hear from. We got the biggest names, including Strategy Executive Chair Michael Saylor, Robinhood CEO Vlad Tenev, among others. Personal finance legend Susie Orman and the Shark Group CEO Damon John are also joining us with tips to help you build your wealth. Don't miss it. Yahoo Finance Invest on November 13th. Securitize is the first company of its kind to go public via a SPAC deal with Cantor Fitzgerald Equity Partners II in a deal worth $1.25 billion. So let's talk more about tokenization and what value it provides to companies and their investors. Carlos Domingo, Securitize founder and CEO, is joining me here in the studio. Carlos, thanks for being here.
Thanks for having me.
So we've talked for a while. So congrats, first of all, on this deal to go public. And Securitize and tokenization has really become a buzzword since we started talking, I think, a couple of years ago. It's really gained a lot of speed. Yeah, exactly. So I want to talk a little bit about the sort of concept of tokenization first and the value that it brings. We are seeing more of an interest in tokenizing a broader swath of assets, right? And I think most interestingly, or most recently, stocks being tokenized is something that has come into the conversation. Why would I want to, and how does it work? Why would I want to tokenize a stock?
So look, just to explain what tokenization is in layman terms.
Yes.
Every transaction in capital markets, whether it's a stock, a bond, a fund, a redemption, an interest paid, whatever, dividend, involves updating a ledger, right? So somebody has to have a record of who owns what and how that transaction affects the ownership change, and also, the money that you've, used to pay for the transaction. So tokenization is nothing else but taking these securities and that are in antiquated ledger technologies, siloed, not connected to each other, and put them on a modern public distributed ledger technology like a blockchain is, to provide all these efficiencies. So why people want this? Well, it's going to democratize access to a lot of assets. It's going to make the assets easier to move around. It's going to make them easier to borrow against them. It's going to make it easier to receive dividends on time, etc. So ultimately, this becomes like a better way of holding and trading the assets.
I guess what I'm confused about is why create a token twin of the asset rather than just securitizing the asset itself?
That's a very good question. So what we do is we actually work with the issuers. So when we issue a token, the token actually represents the security. There is no other copy of that security anywhere else. It's not a twin. It's the actual native representation. It's represented on a different ledger, a blockchain, with the entry on that ledger is called a token. So it's not a twin. This is a native representation.
Well, but for example, if it's a stock, it's not the stock. You're not owning the stock itself,
you are.
You? Okay.
Yeah, of course. So actually, most people don't realize that when you, let's say, buy stocks on Robinhood, they're not under your name on the cap table. They're actually under the Central Securities Depository, the clearinghouse. DTC has a company called CD&Co that all the stocks are actually under their name. But you can actually request those stocks to be placed under your name through an entity called a transfer agent, which every publicly traded company has. And then when you do that, if the transfer agent uses a blockchain as their ledger, then that's tokenization, and you're going to get a token. So it's actually a better mechanism. You're actually really owning the stock. You really have rights. You can vote directly. You can receive the dividends immediately because they will know that you are a beneficial owner, etc., as opposed to holding the stocks in the traditional way.
Okay, so we've gone a little weedy here, a little bit in the weeds. But ultimately, do you expect that the whole U.S. stock market will be tokenized? And will that, in effect, replace the ledger system at some point?
So look, new technologies don't necessarily completely displace all technologies, right? Like today everybody uses cloud and PCs and phones, etc. But some banks still have the mainframes where they run their old systems, right? And they've never got rid of them. So I do believe that the existing financial services industry, as we know it, it will not be completely displaced, maybe over time, but a very, very, very long period of time. But a new market that is based on blockchain rails, that is more efficient, is faster, is cheaper, is easier to access, will emerge in parallel, and eventually, over time, will be migrated over there.
What is the feedback loop from tokenization to the underlying asset? In other words, is there a risk that disruptions in that market or moves in that market will create a feedback loop to the original asset?
It does not, right? So the tokenization is simply that the token represents the ownership on the asset. So whether the asset changes or not in price, it will happen irrespective of whether you have a token or you have another mechanism, right? So, of course, today markets, they actually, have certain regulations around guaranteeing certain price for transactions and stuff like that. So when you create markets on chain, you need to figure out how that you're going to provide the same guarantees. But besides that, the token itself is not going to be disrupting anything as far as it continues trading according to existing regulations.
Where have you seen the biggest demand for all of this?
I mean, look, with one idea is that here in the US, we're very spoiled because we think that it's very easy to access stocks, and everybody has brokerage accounts, and we have companies like Robinhood and others that have really democratized access to this. But as a European, in Europe, the same thing doesn't happen. People don't have access to brokerage accounts. They don't necessarily, transact on stocks frequently like people do here, etc. But they do it with crypto. So there's an argument. Sorry, I've been talking a lot the last 2 days.
Yeah.
There's an argument that you can, give access to non-US people in a more efficient way through tokenization than today with normal markets.
Interesting. Okay, so there is that potential for it to be more of a use case elsewhere.
Sorry.
When do you expect the SPAC combination to be complete? And I'm curious why you decided to go SPAC versus a traditional IPO process, for example.
Look, that's a good question. So we look at both options. In our case, we thought that an SPAC done the right way is a very good mechanism for a company of our size. And it also kind of like de-risks the process and the outcome. We've already done it. We already announced the valuation. We already raised the pipe. So that's all done. And now we need to do the regulatory filing, as opposed to a traditional IPO that we'll have to do the regulatory work ahead and then go to the market maybe in Q1, Q2 next year. So with this process, we're done. We already have our partner. We already have the money in the bank. We already have the valuation set. And then, as soon as the government opens and we can actually file with the SEC a document called the S4, which is the merge agreement between the two companies, then, they'll take 2 or 3 months to review it, hopefully, and then we'll go, we'll become publicly traded and replace the ticker of the SPAC with our ticker.
Okay, thanks so much for coming in. Appreciate it.
Thanks for having me.
Good to see you. Shares of Cardinal Health rallying to a new record high after the pharmaceutical products manufacturer and distributor reported a 22% quarterly revenue increase and boosted its outlook for fiscal 2026. Joining me now, Aaron Alt, the Chief Financial Officer at Cardinal Health. Aaron, thanks for being here.
Julie, good morning. Thank you for having me. It's a big day for the Cardinal team and a big day for Cardinal Health.
Yes, indeed. With the increase that we're seeing in those shares and the increase you guys had in the quarter, just give me sort of a big picture, top line, what was really driving the growth during the quarter?
Yeah, we have 5 operating segments, and all 5 of the operating segments had double-digit profit growth over the course of the quarter. It's been driven by a couple of things. The first is strong demand really across our portfolio, particularly in the pharma business, whether it was in branded goods, generic goods, our consumer health business, our specialty portfolio. We saw strong demand in the quarter, and that certainly helped. We also saw strong execution, where we've been working really hard over the last several quarters to raise our game and make sure that our service levels are high, and the team really delivered for our customers over the course of the quarter. And at the same time, we've been investing for the long term, and we're starting to see the benefit of the investments we've been making organically in our portfolio, but also inorganically, as some of the acquisitions we've done in recent quarters have now really started to hit their stride.
Yeah, I want to talk a little bit more about those acquisitions. As you said, some of them now showing up more in the numbers, and you've been focusing in some cases on specialties. For example, you're about to close on a company called Solaris, which is in urology, that sort of specialty vertical. How much do you think that is going to contribute? And do you plan to make more of those types of acquisitions in those sort of specialty areas?
Yeah, a couple of years ago, we came to the strategic conclusion that we needed to raise our game and increase our presence in the specialty pharmaceutical area. And we've been doing that a couple of ways, both upstream and downstream. One example is the acquisitions we've done first of Ion in oncology, and then of GI Alliance in gastroenterology, and more recently in Solaris, which is the nation's largest urology MSO. We've been putting those businesses together because that's where Cardinal's strength has traditionally been in servicing those parts of the specialty landscape, and they are now contributing 8 percentage points of the profit growth that we've called for fiscal year 26.
Aaron, I should mention, because you said MSO, Medical Services Organization, if I have that acronym right. For people who are watching who aren't as familiar with Cardinal Health, can you just briefly describe kind of where you sit in the healthcare stack, if you will?
Sure. There's a misbelief that we are just a distributor, and nothing could be further from the truth, and that we are providing value-added services really across the healthcare ecosystem. And so while we do distribute pharmaceuticals, while we do distribute medical goods through our GMPD segment, we're also a strong partner with doctors, with hospitals, with other environments as well. And for instance, in the MSO world, we are actually partnered with practices across the country in core areas where we are helping them with their data, helping them with their running the back office, helping them with the ancillary services that they're being provided, anesthesia, pathology, pharmacy services, et cetera. And really, as we are raising our revenue game, we're also raising our profit margin game by moving further into higher margin services like the MSOs.
So, Aaron, you're really well poised then to answer this next question, which is, what effect are you anticipating from a potential Affordable Care Act subsidy expiration? We did talk to one healthcare analyst earlier in the week who said we may be seeing a little bit of pull forward. In other words, if people are worried about losing their insurance or having to pay a lot more, are they getting things done now? Are they buying, are they stocking up on pharmaceuticals, for example, now? Are you seeing any evidence of that?
We're not seeing evidence of that as yet, but what I would observe is the trends in the healthcare ecosystem are certainly supportive of future growth, right? As we look across the American society, right? We're all aging. We all want to be a little bit healthier, and so we have been seeing strong demand in part because people are starting to take better care of themselves as they age. And while regulatory change is certainly something that's being discussed a lot, we're very confident that we're in a great place to continue to serve the American healthcare patient, the American healthcare medical practitioner, because we provide an essential service, right? In many respects, we are ensuring that they're getting what they need safely, securely, and efficiently across the healthcare ecosystem. So we think there's lots of opportunity.
And Aaron, on the regulatory front as well, I have to ask about the recent pricing negotiations and agreements between the administration and certain individual drug makers. Do you anticipate those kinds of agreements having any effect on your business? I know you guys have a big generic business, but it's not uniquely that. So how are you viewing that?
Yeah, we share the administration's goals of access, affordability, and innovation. And we believe that we are a critical cog in that wheel, regardless of how the model may change or how benefit decisions may be taken. And so we're excited to partner with the drug manufacturers, excited to partner with the acute environments, with the doctors, with the administration to ensure that the American healthcare consumer is getting what they need, when they need it, in an efficient way. They've got the access, and hopefully driven by incremental innovation within the drug environment as well, because innovation is good for everyone.
Indeed it is. Aaron, thanks so much for your time. Appreciate it.
Thank you for having me.
Coming up, we'll have full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. minutes into the start of U.S. trading. I'm Julie Hyman. Let's get a check of the markets. If you take a look at the major averages here today, we are still seeing a mixed picture with the Dow gaining 326 points or so. That's up 0.7%. The Nasdaq going in the other direction, down 1%, and the S&P 500 hovering somewhere in the middle. A lot of cross currents today related to earnings. Of course, big drag from big tech earnings. But let's talk about two stocks in particular that reported. Chipotle, those shares are tanking today after the CEO suggested consumers are pulling back. Senior reporter Brooke DePalma joins me now with some of the top takeaways from that company's earnings. The shares right now down 17%, Brooke.
Julie, this is the worst day for Chipotle's stock as far as intraday trading goes since 2012. And there are a few factors that CEO Scott Boatwright said in the call that really sort of is making investors a bit weary here. Some of those key takeaways that we heard on the call is that they cut their guidance for the third time this year. They now expect same-store sales to decline in the low single digit for this fiscal year. And some of the color that he provided was insight to trends that we've already been seeing. He said, one, young consumers are pulling back. He said that ages 25 to 34, which it tends to over-index to, well, he said that they're particularly under pressure. He said that there are three key headwinds that this age group is up against, including unemployment, increased due loan repayment, and slower real wage growth. And that's really causing them to visit Chipotle a little bit less. Also, that low and middle income consumer, as we've been hearing, Chipotle seeing that income cohort under pressure. He said that households who make $100,000 or less, well, it makes up about 40% of their total sales. And they're also pulling back on their trips to Chipotle. And all of that is leading to this, maybe a bit of a pullback of investors. We also got a price target cut from TD Cowen. And so multiple different factors going into this pretty significant slide today.
All right, let's talk the other stock that we've been watching. Starbucks in that industry seems to be making progress in its turnaround. Brooke, what can you tell us there?
Yeah, well, investors seem just a bit optimistic. The stock's moving just ever so slightly higher as CEO Brian Niccol, worth noting, he was the former CEO of Chipotle. He really gave this optimistic outlook about Starbucks' turnaround story. He said some few key things that got investors excited here. One, it was the first positive quarter of global same-store sales growth. It increased just 1%, but it's the first time that it saw positive same-store sales growth in nearly 2 years, the first time in 7 quarters. And that somewhat got the street excited. But worth noting here that U.S. same-store sales, well, they were pretty lackluster. They remained flat. But the company did say that they're seeing positive same-store sales growth in both September and October. The company said it was encouraged by those trends that it is seeing. But he did say that consumers, they're still a bit choiceful there. Now, the key part that investors are really giving patience to Starbucks here. This is 1 year in for Brian Niccol. He's on his way to the second year. And they're in this midst of this huge turnaround strategy. And what he said was that Q4 was a turning point in this multi-year turnaround story. He said that they have good reason to believe that U.S. same-store sales should build throughout the year, but he said that recoveries are not always linear. And so it seems like investors are giving a bit of patience here for Starbucks to really execute this turnaround strategy as it looks to get more consumers into the door. Of course, it introduced that protein cold foam. It also reintroduced their pumpkin spice latte lineup as well during this quarter.
Oh, the PSL. You cannot escape no matter what you do. Brooke, thank you so much. Appreciate it. All right, let's take a deeper dive into the Starbucks and Chipotle financial pictures and the broader dining sector. Joining me now, Peter Saleh, BTIG Managing Director and Restaurant Analyst. Peter, it's great to see you. That Chipotle quarter, a bit of a woof, it feels like, in the markets here. And as you put it in your note, where have the millennials gone, right? What is going on here? Do you think it is just a matter of acute price sensitivity right now?
So thanks for having me on. Yeah, I mean, it is a little concerning. It seemed like a rather abrupt decline. They weren't really talking about this in 2Q, this softening of trend among this consumer. It seemed to happen all of a sudden in the months of September and October. But we think that cohort of consumers earning 40 to 100,000 makes up about 35% of their sales, and the income cohort 40,000 below makes up about 5%. So it's really that middle income consumer that we're most concerned about, that 25 to 35-year-old consumer making between 40 and 100,000. They seem to have fallen off particularly a little bit in September, but more so in the month of October. Not sure if the government shutdown has something to do with it. I guess we'll see when the smoke clears on that. But it does seem like that cohort is under a fair amount of pressure right now.
Now, Peter, you said it also in your note, you're not convinced that affordability concerns are the main driver, but that said, we don't know what it is exactly. I don't know. I don't know if something's going on, sometimes I wonder if there's something online that's affecting whether people are buying something. But I guess we don't know the answer to that either. I mean, is it something that Chipotle can address?
So if it is affordability, I think they should be able to address that rather quickly with some unique and different advertisements and marketing. We did a lot of work on this over the summer. We found, you really can get an entire meal there for around $10 if you don't order the guac. On average, a chicken bowl is around $10. That is substantially cheaper than many of their fast casual competitors, 20, 30, or even 40% cheaper. So I think on value, they are winning. They should be winning. Maybe the consumer doesn't see that. Maybe they just have to bring that to the forefront. They did try that with some ads over the past several months that kind of hinted at a $10 price point, but they didn't put that on the actual screen. So, and maybe that wasn't broad-based enough. I only saw it one time. So I think you can probably move the needle on value and affordability with some more marketing in the fourth quarter and maybe into 2026.
And it seems like you still have confidence that they can do that, Peter. You've got a buy rating on this, a $45 price target. Are you confident they can turn the ship?
So this is the largest fast casual concept in the U.S. They don't have any real competition in the fast casual Mexican category. They own the entire category. So in our view, they've got the balance sheet, they've got the management team, they've got the assets, 3,600 units and growing. So in our view, the returns are still very good for the new stores. They will continue to build new stores. I think it will take some time to get the message out on value and move the needle there, but we do think they'll be able to turn it around.
All right, let's turn to Starbucks here. I liked your cute title on the note, 2 pumps forward, 1 pump back. Is this a 2 pumps forward quarter, or is this something that you found encouraging?
Yeah, so best quarter under Brian Nichols' leadership, so that's encouraging. They beat on same-store sales globally and in North America. Their traffic improved globally to positive. Trends improved sequentially through the quarter in North America, the most important segment of the business. And they turned positive in September, and that momentum continued into October. So that, to us, is very encouraging. I think next year they will have better throughput given all the investments they've made. They're going to remodel a bunch of stores as well, which should help. And they'll have more menu innovation. So I still think they're very early in the turnaround, but we're seeing some evidence that it's at least stabilizing in the near term.
Peter, where do we still need to see the biggest area of improvement for Starbucks?
It's really their North America, the U.S. business. That's the lion's share of where they make all their money. So, an improvement in traffic there is nice in September and October, but we'd like to see that momentum continue throughout the fourth quarter. Especially into holiday, very important season for them. And then we'll hear more from them at the very end of January next year when they host their Investor Day in New York and give us a lot more detail on how 2026 is going to look and the go-forward algorithm.
Peter, you cover these two stocks, but you also cover, everything from McDonald's to Domino's, the sort of whole complex here. From what we have heard and what you expect to hear from the companies that haven't reported yet, how is consumer spending on eating out at these places? Can we draw any bigger conclusions, especially considering those Chipotle numbers?
Yeah, I think they're choppy, and they've been choppy really all year. So we've been talking about the weakness of the lower income consumer really all year. In the first quarter, we saw some choppiness with that middle income consumer that kind of maybe went away in the course of the spring and the summer, and now it's back. So it's been choppy, and it seems to be migrating up the income stream. So I don't think it's very healthy. Clearly, if you watch any sort of TV, almost every other commercial is a deep value discount. We don't love this environment given all these discounts, but it is what it is for the time being. They're putting up a lot of discounts to drive in traffic, so the environment's really weak. Also, we don't think the GLP-1 situation is helping. We found that a third of GLP-1 users are considered lower income. They're pulling back on dining out as well. So there's a lot of pressures on the dining out space in 2025, and some of that likely continues in 2026.
Peter, good to see you. Thanks a lot for joining us.
Thank you.
All your markets action coming up, including a check of trending tickers. We'll be right back. Now time for some of today's trending tickers. We are watching Comcast, Stellantis, and rare earth stocks. First up, Comcast, reporting revenue and earnings topping Wall Street estimates, but the company did see its fourth consecutive quarter where it failed to grow its broadband subscriber base. Joining us for more, our Ali Canal is here with me on set. So how did it all sort of balance out?
Look, broadband has been a struggle for Comcast for many quarters, many years. It was better than expected, though. They lost 104,000 broadband customers, as you said, Julie, the fourth straight quarter without growth. The expectation, though, was for a loss of 140,000. So that initially boosted shares a bit, but then we got on the earnings call, and executives said that the broadband environment remains intensely competitive. So you could look at names like AT&T, Verizon on that front, and that profitability in the unit will keep declining as Comcast invests in mobile, simpler pricing, and overall customer experience. So that shift plus a 3.5% drop in broadband-related earnings, that spooked investors a bit, setting shares lower. We are off the lows of the morning session, but still down around 4%. So, broadband's an issue, and then in the background, you have maybe some M&A activity too. Warner Brothers Discovery is for sale. They announced that. Comcast has been rumored as one potential buyer here. Executives were asked about this on the call. They didn't say, yes, we want to buy this, property, but they also didn't totally close the door.
They didn't say, no, we definitely don't want to.
They didn't say no. They said after the Versant spinoff, which is those cable properties, there might be opportunities there and that there are viable options that the market maybe has been discounting.
Ali, I have to say, I did not realize. I just took a look at Comcast year to date, and it's down quite a lot over the past year. Yeah, one of the worst performers in that sort of media and telecom group. So,
and I think that's one of the reasons why some Wall Street analysts, Rich Greenfield from LightShed Partners, he's been really advocating for Comcast to go after Warner Brothers Discovery because he says that could create some sort of Disney-like competitor, and Comcast has always wanted to be a Disney, and this could be the opportunity, especially with shares off so much. We'll see, though, if they commit to that. It seems like Paramount Skydance really wants to go after WBT, but definitely a lot of shakeups and moving and grooving in this Hollywood space.
Makes it fun for you. All right, let's talk about Stellantis. It issued a warning on one-off costs through the second half of the year. The stock is taking a hit on that news. So, Ali, what does this have to do with?
So, one-off costs tied to political, economic, and regulatory shifts here. Now, Stellantis saying that it may cancel projects or products as it adjusts its global footprint, and that these cancellations could bring cash impacts. So that tangible effect there that is not sitting right with investors. Now, it is the latest setback in this turnaround effort for the company, even as North American sales have improved. The stock is down roughly 30% this year. We have the pressure from tariffs. We have Europe's overcapacity, and of course, the growing Chinese EV competition, which we know across all these automakers, especially within the EV space, that's definitely something that's a concern for some of these stocks.
And then finally, let's talk about the rare earth stocks. We talked about them a little bit earlier in the day. It's a mixed picture after President Trump's meeting with Xi Jinping. Initially, a lot of these names were actually higher after the trade truce, but investors seem to have changed their tune to some extent. I mean, earlier when they were up, it was sort of confusing because China has agreed to pause their export controls on rare earths, or their most dramatic and strict controls. So you would think that would not be great.
Right, because that would mean more global supply, lower pricing power. So traders who had these bids out there that the stocks would rise and supply risk fears are now maybe taking some of those profits here. So really a buy the rumor, sell the relief move, it seems like. But this was a big tension point in U.S.-China trade negotiations. The meeting overall was interesting to me, Julie, because yes, we got some clarity on things, a delay for the rare earths. We have the restarting of the soybean purchases, which is obviously a big relief to American farmers. But overall, I still think there's a lot of question marks. There's more to be desired here, especially when we look at NVIDIA. Really no talk at all about the sale of those Blackwell chips. It's something that President Trump said NVIDIA will figure out directly with China.
Yeah.
I don't really see how the president doesn't get involved with that, but again, we're continuing to wade through those headlines and really digest what this all means for the global trade landscape.
And a moment of perspective also on the rare earth stocks in particular, like MP Materials is up 300% this year.
Yeah.
USA Rare Earths is up something like 70%. And it's not as though the US government has said, they've already talked about making investments in some of these companies and supporting the industry. And even despite this agreement with China, there doesn't seem to be any change in investing in the homegrown industry for this stuff.
Yeah, and obviously it's not just the rare earth stocks. They're also investing in a lot of these tech companies too, and taking out these unprecedented moves to really make sure that we can secure this domestic manufacturing, whether it be within tech or these minerals.
Right, exactly. Thanks, Allie. Appreciate it. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, we'll be speaking with Eli Lilly CFO about another strong quarter for the company and for GLP1 sales. Morgan Stanley has agreed to buy EquitiesZen. It's a trading platform that allows users to buy shares of private companies. And it comes as investors become more interested in owning pieces of highly valued startups. Joining me now, EquitiesZen CEO Atish Davda. Atish, it's great to see you. And I have to say, we've been talking for a few years now, so congrats on this deal. And we tend to talk to you about the IPO market and what's exciting on the private side of the business. And obviously, Morgan Stanley thinks there's a lot exciting on that side of the business. So just talk me through how this deal came to be and what you hope to get out of being part of that bigger entity.
Totally. And it's so good to be here again. You're totally right, Julie. We usually talk about IPOs. The challenge is companies are staying private longer and longer. So you have fewer IPOs. The number of publicly listed companies continues to be at an all-time low. And so if you're an investor that's only investing in public stocks, you're missing out on where a lot more value creation could be occurring, which is just, in other slices of the, of the portfolio. And so where EquitiesZen and Morgan Stanley came together is really several years ago. For the last couple of years, we've been trying to figure out a way to work together. Now, look, Morgan Stanley is a world-class organization, but it's a real pioneer in the private market space. They, acquired Solium ShareWorks, and they have the Morgan Stanley at Work program. And by doing that, they've been servicing private companies for a very long time. The piece that's been missing is the piece that connects all of that supply to the demand side, which requires technology, and it requires an issuer-friendly platform, which is essentially synonymous with the way EquitiesZen has tried to do business over the last 12 years.
And so as part of this deal, will that mean that Morgan Stanley customers have access to these private companies via EquitiesZen? Does that also mean that people outside of the Morgan Stanley ecosystem will not?
Actually, what we want to try and do is have EquitiesZen and Morgan Stanley really, join together. Morgan Stanley has this fantastic vision of an integrated firm, and I'll tell you just, really quickly why that was really appealing for EquitiesZen when we were trying to figure out, well, what is the right way for us to expand our distribution at a global level? Morgan Stanley has an investment bank. It has capital market syndication desks. It also, of course, has asset management arms and wealth management arm. And I think when you kind of take the whole firm together, what a private market solution can provide and what EquitiesZen specifically can bring to the table is connectivity to the self-directed user that Morgan Stanley has with E-Trade, to the issuer client that Morgan Stanley has with Morgan Stanley at Work and with its Solium ShareWorks platform and the equity plan services, and also with the liquidity provision that Morgan Stanley already offers as part of their tender offer business. And so you kind of have the demand that Morgan Stanley already has at a world-class level. You have the supply and the issuer relationships that Morgan Stanley has at a world-class level. And the gap that EquitiesZen is really bridging for them together is the ability to connect the supply with the demand in a way that the issuers are actually really thrilled about.
Atish, I have a bigger picture question for you, which is with this increase in accessibility for investment in private companies that, it seems like people are clamoring for. Of course, there are differences between private and public companies, and one of the most important is that you don't have the transparency in those private companies as investments. Is there a way to solve for that? Do you think there will be some level of increased transparency going forward as these investments increase?
Look, as companies start getting bigger and bigger while still staying private, OpenAI is a great example of this. You currently have a large private company that has recently had a lot of equity research get initiated on it. So I think, I think the question used to be, will there be regulation that forces issuers to disclose more even while they're private companies? And I think what we're seeing is the market is answering that question. Companies want to educate the market more. Companies want to educate its client base more. And by virtue of doing that, you have conversations like the equity market coverage that is beginning to initiate on private companies. And I think that's going to keep going. But the important thing, however, is that the companies need to have control over it. I mean, EquitiesZen's platform has been built on the premise that the issuer has to have a seat at the table. It's an issuer-approved platform. It's actually why Morgan Stanley and EquitiesZen, we think, made such a fantastic match, because the issuer really is at the center of the entire ecosystem.
And just really quickly, Atish, do you think that there will be fewer companies going public still as a result of all of this?
I think that more companies that are private will continue to stay private longer. I'm not saying IPOs won't come back, but I think if you compare the proportion of companies that are public versus private, I do think the private pool will continue to grow more. If you just take a look at the market cap of private companies, you're talking about it being in the trillions now. That used to not really be the case, even as recently as 10 years ago. EquitiesZen's a 12-year-old platform, and we are very excited and fortunate to be able to take our know-how and learning and really catapult it onto the global scale and the institutional level that Morgan Stanley operates on.
Eli Lilly reporting another strong quarter for GLP1 revenue, with sales of both Zepbound and Mounjaro more than doubling in the third quarter. The drug maker raising its full-year guidance, anticipating sales of at least $63 billion. And joining me now for more, Lucas Montarce, Eli Lilly Chief Financial Officer. Lucas, thank you so much for being here. Obviously GLP-1s have been the thing. Obesity drugs have been the thing that have just caught fire both in the marketplace and in investors' minds. But I would like you to talk to me a little bit about Eli Lilly and sort of the other stuff too. In other words, how much should investors think of Eli Lilly as an obesity drug company versus the obviously you have a lot of other products as well?
Yeah, thank you for having me, Julie. As you mentioned, a very strong performance for the quarter, growing 54% versus the prior year, and upgrading basically our guide for the full year. Your question about the GLP-1s and incretin's portfolio, of course, is front and center of the growth that we have. But you mentioned we have a breadth of a portfolio. We operate in 4 big therapeutic areas, including immunology, oncology, and neuroscience as well. And all those products, the rest of the portfolio is actually growing double-digit as well for the quarter. So we continue to make progress not only on the incretin side, but also on the rest of the portfolio. And we have a breadth of the pipeline. Dan alluded to this during the earnings call, that is across all the therapeutic areas.
And, all of that said, yes, the obesity drugs did see very strong demand in the quarter as well. How are you thinking through that demand in terms of distribution, in terms of the patients that have accessibility to them, and where do you see future growth as a result of all of that?
Yeah, we operate, as you know, again, we launched in the US a few years ago, and now we are expanding the launches on all US markets. We mentioned during the call that we are now present in 55 markets with tirzepatide. So very excited that we are bringing this solution to all the patients around the globe. And we operate in different channels. Of course, again, front and center is how we continue to provide access to patients across the different channels in the US, Medicare, Medicaid, but also on the commercial front. And we continue to make progress across each one of the segments. In particular, very excited to see also what is our Lilly Direct portfolio that is direct to patients, direct to consumers, that we continue to grow extensively. This quarter actually grew 70% versus the prior quarter. So continue to see an acceleration of growth on that channel. That is an easy way to reach basically patients and go directly. As long as you have a prescription, you can get the product delivered at your home. We actually announced yesterday also a partnership with Walmart, that we are bringing this product as well, that patients can pick up the product at the Walmart store around the United States.
And I was going to ask you about that Walmart partnership and that sort of, how are you thinking about the balance of accessibility and price? What is most important in the marketplace right now?
Yeah, of course, there is an elasticity in the marketplace with regards to these molecules. How we think about it is, if you look at, I think the best proxy that we have is this Lilly Direct platform. We have a price and a starting point at $349. Basically, it's a very competitive price if you think about the benefit of the products. And we have actually more data coming out there about tirzepatide and the new products coming into place as well, that we bring basically more solutions to patients on this channel as well. So we think about the elasticity of the product. We feel really good about the growth that we are seeing and giving access to more patients, not only in the US, but also globally.
And, when you look at the potential for these products, I know that you said on the call today, one of your colleagues talks about the studies that you're continuing to do on tirzepatide, not just for obesity, but for types of addiction, for example, alcoholism. So how are you internally viewing the potential of these medications?
Yeah, well, again, I think we are just scratching the surface of the potential of these incretin molecules. And again, we announced it all today that brenipatide, that is another asset that we have in the portfolio, that we are going to be doing studies for alcohol use disorder. And they've alluded to this, that we are exploring also other addictions as well, including opioids. So we are exploring in multiple ways how these incretins can benefit basically patients in different therapeutic areas. We also have actually announcing studies, for example, in immunology. We are running studies in combination with Taltz, and we have studies that we announced today as well with Ombo for ulcerative colitis, as well as Crohn's disease as well. So we are expanding and looking at this incretin class across the different therapeutic areas.
How is supply going at this stage, and is demand still outstripping supply, or is it in better balance?
We are in a very positive and good situation at this time. We are shipping to all our wholesalers globally every single day. So we are in a good position to continue to supply the market. Of course, we are ramping up our capacity as well. And this has been a multi-year investment that we are doing. We announced new sites as well. One, in fact, this week that we are expanding in Puerto Rico. 2 new sites in the US, one in Houston and Virginia. So not only we are supplying every day, but we're thinking about mid and long term and expanding our footprint and capacity to continue to supply the demand and the marketplace.
I'm curious about pricing because, as you mentioned, a lot of folks are going through the Lilly Direct platform. Is there any concern about in an economic downturn that people might then pull back if they're not, for example, buying it through insurance?
Yeah, well, of course, we continue to work with employers and insurance directly to continue to expand the access as well there. And again, patients can get the products as well. In fact, last quarter, we announced also a new program that just started. So it's early days to give any perspective about the performance, that we call it frictionless PA, that basically starts sharing the cost between the employer and the employee about getting access to these obesity medications as well, to tirzepatide, having an access in a different platform. But again, we continue to make progress and working with the PBMs and employers to get more patients into these medicines.
Lucas, there was a report earlier this week that you all, you are of course working on an obesity pill as well. to
Yes.
augment the injection. And there was a report earlier this week that you guys are already cranking out those pills, even though they haven't been approved yet. You're getting ready for that eventual approval. But where are you on the approval? First of all, can you confirm that you're already producing these? And secondly, what's the timeline then that you're expecting for approval?
Yeah, good question. And yes, the answer is yes, Julie, to your question. And we share this openly every quarter. Actually, you can look at that on our filing. We have a line that we call it pre-launch inventory, and that's mainly basically that we are producing our Forglipron, that is our oral GLP1, that we are planning to file in Q4 and hopefully getting into the market next year. And of course, again, given all the learnings and the demand and the size of the business, we are actually manufacturing this at scale as we speak. We don't get into all the extrapolation on how much revenue this represents, but the way that we think about it is to be ready to have a global launch, right? And be ready commercially and manufacturing when the product is approved in the marketplace, not only in the US, but also globally.
Do you have any inkling as to when that might be?
We are working, again, as fast as possible internally to file it first. That's the first step of the process. We already communicated that that will be taking place now in Q4. And we are well on track to file it. And of course, again, there are different options on how we can bring the product into the market. There is this new commissioner voucher review that, again, we are trying to also explore that option. But we have different ways. We have a priority voucher review as well to get the product into the market. So our approach is to get the product as soon as possible to the US patients and then also globally.
Lucas, a couple of your competitors have come to agreements with the U.S. administration on pricing. And I'm just curious what progress Eli Lilly has made, what you can tell us about a potential agreement on your part.
Yeah, we are in discussions from day one with the administration, and the conversations are progressing well in many different fronts, by the way, that we talk about today, for example, direct to patients. We have the Lilly Direct platform for several years now. So there's a common ground with the administration that this way to bring the product to the patient in a transparent way is a way to also basically provide the products to the patient in an affordable way. We are also thinking about, the administration talks about how we can make, again, the price basically more balanced around all the mature markets. And we are sharing the same view with the administration. So we are working on common grounds that we have. There is no update that we can share at this time, but we are progressing in our discussions.
And Lucas, thank you for that. And finally, and thank you for your patience here, you guys really did have a busy week because you also had an announcement with NVIDIA that you are going to be building a supercomputer with them in order to use AI for drug discovery. So this is in process, this is obviously not being made tomorrow, but I'm curious there too. When do you expect the first drugs potentially to come out of that process?
Yeah, exciting times. As you mentioned, a lot of news coming out. We talk about manufacturing, pipeline, but also, again, how we advance on the use of AI. We actually got into this partnership with NVIDIA for a supercomputer. Actually, the chief technical officer is actually seated right next to me in this office here. Super exciting opportunity. We are going to build that data center. Actually, will be up and running as of most likely early next year. This takes time, right? Again, on the discovery front, it takes time to bring molecules to the market. But again, both scientists and, of course, our technology team are super excited about this opportunity. This will actually accelerate our development process, more so in on the discovery, but also on development as well.
Looking forward to keeping in touch and seeing what comes out of that. Lucas, thank you so much. Appreciate it.
Thank you for having me. Have a good day.
You too. We are counting down to a big day here at Yahoo Finance. It's Invest on November 13th, starting at 8 a.m. Eastern. We've got a full day of live coverage of the key themes driving the market, AI, crypto, and much more, with the top guests you'll want to hear from. We've got the biggest names, including Strategy Executive Chair Michael Saylor and Robinhood CEO Vlad Tenev. Among others, personal finance legend Susie Orman and the Shark Group CEO Damon John will also be joining us with tips to help you build your wealth. Don't miss it, Yahoo Finance Invest on November 13th. Brent, it's good to see you. So I do want to talk about NVIDIA for just a second here and this enormous AI trade that seems to show no sign of slowing down. I mean, we've had some little bit of fits and starts, but overall, it's just up and up and up. Do you just sort of risk being bulldozed if you don't hang on for dear life and ride this thing?
Yeah, I mean, certainly you want to have exposure to it, but how much exposure do you want, given the fact that single stock concentration can be incredibly risky, especially longer term, where at least historically the winners of one cycle typically aren't the winners of the next cycle. And that's where I think investors should continue to diversify, because no one knows exactly what's going to happen. And as you mentioned, the market's been incredibly narrow because the economy's been narrow. So if you think about the past year or so, you've had parts of the economy that have been impacted by interest rates and parts that haven't. Those parts that haven't are mainly AI in nature and higher income consumers. And that's where you've seen an incredibly narrow market, which at least historically has given way to a broader market. And that's why I would encourage your investors to stay diversified across the spectrum, but obviously while continuing to own some of those names that are benefiting today. How
do we know that history is going to repeat itself, or that historical reversion to the mean is going to reassert itself? In other words, like, it's already been narrow for a good long time here. What's to say it can't continue to be?
I think history does repeat because we are the human beings who have written history and the human beings who will write the future. And so if you think about that from the standpoint of economic agents, we are the people who have driven the economy in the past, and we are the agents who are driving the future. We are the people who invested in the markets in the past, and we're the people who invest in the markets in the future. And we are all behaviorally flawed and have been throughout history. And so history certainly can change. The economy is a bit different than it was over history. But if you think about all the things that are the issues that humans have, they are the same issues that we've had before. And that's why I think you see booms, you see busts, you see bubbles and everything else along the lines. And that's where I think history is a pretty good guide for what happens next. And at least going back 50, 60 years, every narrow market has seen a broadening market on the opposite side. And today's market, the percent of stocks that are actually beating the S&P 500 is as narrow the last 2.5 years as it was in 1998, 1999.
Does the broadening have to come with the bubble bursting?
Yeah, I shouldn't use the word bubble, I suppose. I think it doesn't have to occur that way. What's likely to occur is what you're seeing today. Maybe the kind of the train tracks are being laid. If you think about my opening comment about interest rates being the impact and kind of being the dividing line between the parts of the economy that have worked and the parts that haven't, you're seeing rates move lower. The 10-year is 80 some basis points or so off its earlier high this year. The 2-year a similar amount. And that's where if you think about those rate cuts coming, hopefully that continue to bring rates lower, you're likely to see small caps and mid caps, which are more economically sensitive, which are more impacted by rates, do just a bit better, as well as the housing market, which you saw today, some better housing data.
So if you're looking to small caps here, and this is a group that, the recovery there has been long anticipated and finally has started to materialize, Brent. Do you buy one of the indexes? Do you apply more of a screen? How do you think about your small cap strategy?
So we use the S&P 600. One of the pushbacks I usually get is these are unprofitable companies. So if you want profitable companies, go to the S&P 600, which has a profitability screen within it. And then certainly active management, I think, will do better in the coming years, even in the large cap space. So if I go back to 1998, 1999, which I think this time period has tremendous echoes of, it doesn't mean that it has to be a bad ending, but what it does mean is that active management did much better in the coming years, as you saw the market broaden out from that 28 and 32% in 98, 99 of stocks beating the index, which is what it is today, and it's 31% this year. You saw a much broader environment going forward, which is when active management tends to do better because most active managers don't concentrate in a few names that have driven the market higher, which is what you've seen today. And as it broadens out, that is a much better environment for active management in total.
Hey, Brent, I'm curious if this thinking or this message is a hard sell for your investors. I mean, they're looking at NVIDIA $5 trillion. They're saying, I want more of that. Are you finding it difficult to convince people?
I've done this for 31 years, and every time there is a market like this, which occurs typically later in an economic cycle, think about the late 1990s, a similar time period. No one wanted to own international. No one wanted to own emerging markets. Everyone wanted to own tech stocks. No one wanted to own commodities. The next economic cycle saw those asset classes that I mentioned that no one wanted to own do better, to where I got to the period in 2007, 8, 9, and even 10, where no one wanted to own the U.S. any longer because it was long believed that the Eurozone was better, that China would eat our lunch and become the world's dominant economy, and that's where people wanted exposure. exposure. And that's where that over the next few years proved to not be the place to be. And so, yes, that is why investing is hard. And that takes me back to the opening comment about the behavioral flaws that we all have, where we draw trend lines out forever and believe that they will continue in perpetuity. I imagine that in the next couple of years, we will be sitting here. We will not be talking about technology stocks in the way that we are today. And there will be a different group of leaders pushing us higher, which at least in the history of the investing world that I can look back at has occurred each and every time.
Okay, so if small caps are maybe part of that leadership, is there another part of the market that you think is really being underappreciated right now that, a few years out, maybe we are going to be talking about?
The one that everyone hates the most, international stocks. And so if you think about the US dollar, which I do believe the US dollar is going to push lower in the coming years, that is not a comment that it won't be the world's reserve currency, just a comment that it's a bit overvalued. There's quite a bit of money that has flowed into the United States. Potentially some of that pushes back out as investors become interested in other places. And I think the administration would like the dollar to be lower to help our trade deficit. But this is where, if you look historically, the direction of the dollar has determined whether or not U.S. assets win or international stocks win. And so when the dollar tends to fall, you do have international stocks win. And if you think about it, if you're investing in Europe and you're taking a dollar out of your pocket, you invest in euros, you buy the euros, you get the profits and the dividends in euros. And when you go to return them to your profit or your pocket, if the dollar has fallen, you buy more dollars, which is a tailwind to your return. And that's what's happened this year. So international and local currency is up about 20. In dollar terms, it's about 29%. The dollar index has fallen by about 9%. And I expect that tailwind to continue in the future. And maybe just one last one real quick. I do think real assets such as commodities, I do think you are likely to get into a period of higher inflation in the future, which means you probably need a bit of real assets in your portfolio. Commodities, typically broad commodities, have the highest correlation and beta to inflation, which I expect to be something that we're going to be talking about somewhere into the future.
Super quickly, Brent, do you like gold as part of that?
Gold is a part of a broad commodity complex. Again, I would not concentrate in gold, especially given the run and kind of the push that it's had by individual investors. But certainly it is a part of the broader commodity complex. But I wouldn't make it my only answer in commodities.